Hey everyone, Erica here with Paragon Accountants. Today we're going to talk about the federal and state tax differences that you need to be aware of. So stay tuned. With tax season fast approaching, many of you are meeting with your tax professional for some end-of-year tax planning. While most of us focus on the federal side of the tax code, did you know that your state may limit or not allow a deduction that you're eligible for on your federal return? Similarly, your state may also have its own deduction and credits that you want to consider. After all, maximizing your tax deduction reduces your tax bill and increases tax savings, and we all like that. If you're in California, you'll want to listen up because in this video, I will compare some standard federal tax rules and how they differ from California so that you can be a better informed taxpayer. So let's begin. Exemption in income in California. Certain types of income are exempt from California tax, although they are taxable on your federal return. These income sources include Social Security and railroad retirement benefits that aren't included in your federal adjusted gross income, but not other private, state, local, and federal pensions. Interest earned on federal savings bonds, your state income tax return, and distributions from health savings accounts, otherwise known as an HSA, unemployment, and California state lottery winnings. Next is taxable income. On the other side, California also taxes certain types of income that the federal government doesn't. These are foreign earned income, interest earned on municipal, state, and local bonds from outside of California. Alimony you received is taxable in California, although it is no longer taxable at the federal level for divorces entered in after 2018, and your spouse paying the alimony or spousal support is also entitled to a tax deduction. So for those of you who this applies to, don't miss out. Non-residents and part-year residents, California taxes its residents on their entire income, regardless of its source, while non-residents are taxed only on the income derived from California. Next, itemized deductions. These are the expenses within the tax code that the IRS or state allows you to deduct to reduce your taxable income, hopefully. Why hopefully? Because your total itemized deductions need to exceed your standard deduction to realize any tax saving. Now, let's compare some federal and state differences when it comes to itemized deduction. First, California does not allow deductions for such things as HSA, adoption, and educator expenses. IRAs and charitable giving are also limited when it compares to the federal tax code. Mortgage interest. In California, mortgage interest is deductible up to a loan value of $1 million, whereas the federal government limits the interest deduction to a loan value at a maximum of $750,000. Utility companies' interests in energy efficient equipment for your home, California allows you to take that deduction. That's a key difference that you may not be utilizing. W-2 work-related expenses not reimbursed by your employer. You may be eligible for a deduction in California, but are no longer eligible for that deduction under the IRS federal tax code. Qualified deductions include but must be ordinary and necessary to perform your duties as a W-2 employee. What do those expenses look like? Travel for business, union dues, some required work attire, tools, and supplies. So don't miss out. Now, we go into tax credits. Here are some of the most common California credits. Number one, we have renter's credit. This is a $60 credit for single renters who fall below a certain income level. It increased to $120 for married filing joint or registered domestic partner filers and are under a specific income threshold. The credit is non-refundable, and you must pay rent in California for half of the year or more. Child and dependent credit. A percentage of the federal credit is allowed for qualified child and dependent care expenses. This credit under California is refundable. Capital gains and capital losses. California generally determines capital gains and losses in the same manner as federal law. However, unlike federal law, California law treats capital gains as ordinary income, and the amount of tax is not dependent on the holding period. California does not permit capital loss carrybacks, and California law does not provide for any special tax rates for capital gains. California no longer allows the deferral or exclusion of gain from selling qualified small business stock. So for those investors out there that are venture capitalists, that's an important keynote to keep in mind. Tax rates. California has 9 tax brackets ranging from 1% to 12.3%, with an additional 1% mental health service surcharge tax on those with income over $1 million. Federal has 7 tax brackets ranging from 10% to 37%, with a net investment tax of 3.8% and a less than 1% additional Medicare tax for married filing joint filers with $250,000 or more income, and $200,000 for all filers filing as single. 2 common business tax differences between federal and state tax law. Number 1, asset expense election under the IRS Section 179 code. California allows a limited asset expense under the IRS Section 179 election for personal income tax purposes that is limited to $25,000 and reduces if the cost of all IRS Section 179 property placed in service during the taxable year is more than $200,000. So for those of you electing the federal IRS Section 179 vehicle deduction, you're going to be surprised on your California return because it's not all deductible in the current year. Number 2, depreciation. Under IRS Code Section 167 and 168, California adopts federal depreciation provisions. However, California does not adopt bonus depreciation allowed under the IRS Section 168K code. Bottom line, what does this mean for business owners? California limits depreciation deduction in the current year that asset gets put into place as business property. So be aware that federal and state have different tax provisions so that you're not caught off guard with a huge California tax bill. I really hope you enjoyed understanding some of the key differences between federal and California tax code, because you could get stuck with a huge California tax bill if you aren't prepared. So like this video, leave your comments below, share and subscribe. We'll see you soon.